Hello, good evening, good afternoon, maybe good morning wherever you are, but I believe in North America, it's more of evening. Yeah, it's good to be back, sharing some helpful tips. So this is brought to you by Obatech Business and Financial Education Center, and the goal is to help bring financial education to our community, to people around us, to let everyone know how finances work in North America. So this will be a weekly time, just a short time, 1 hour, to talk about how finances work. Will be treating several topics, diverse topics to help our communities, individuals on how we can leverage and take advantage of what is available in North America. Um, so, kicking us off on our first series is insurance and legacy building, creating wealth that lasts. So we'll be looking at this topic in this series, and we'll see the subtitles that are coming after. But just a quick bit about myself. My name is Remy Obadele. I'm a seasoned and licensed financial educator and entrepreneur, dedicated to empowering individuals and families to achieve lasting financial independence and time freedom. I'm so passionate about that because I believe we are in an unprecedented time in history, that we have a lot that we can take advantage of. There are lots of things that are available for us at this time, especially now that we're seeing technology and so many things that can help. So my goal, my aim is to help spread that information out, bring that education to people on simple things that we can take advantage of, that can create wealth and help individuals. So I have that passion uh, for helping people turn their aspirations into reality, um, using proven strategies, tools, education that enables to building thriving businesses, and protecting wealth for individuals and for families. So that's just a bit about me. Moving on, like I mentioned earlier on, we're looking at on this topic on insurance and how families can build wealth through it. We're looking at empowering families to build and protect generational wealth through insurance and estate planning. So the topics we'll be looking at life insurance made simple, understanding term, whole life, universal life, critical illness, disability coverages, insurance coverages. Um, that's what we'll be looking at this week. That'll be the point of discussion this week. Next week, we'll be looking at the power of cash value, looking at practical strategies for savings, investments, and having emergency funds, and just touching a bit, on the law of compounding, how, those tiny little bits that we're doing, how it compounds. The following week, we'll be looking at foundations of estate planning, and we'll be diving into wills, trust, healthcare directives, and power of attorney made simple. And the fourth week, we'll be doing those practical steps in building family legacy plan. So on the fourth week, it will be more practical, more hands-on, possibly using case studies, and things are available, and see how we can build things around that. I'm coming up with data, facts, things that are really happening in today's world, to help drive this conversation. So for one of the key goals that we are looking at is, after this 4-week series, um, everybody, every participant, anyone that watches the replay, um, should be able to say, okay, true love for yourself and for your family, and is you are not leaving anything in doubt, and making sure your family is protected and your estate is in order. So yeah, having a plan for your own self, and building generational wealth. So without further ado, we'll just go right into the topic here. And where are we starting from? So more of these conversations will just be around pretty much high level definitions, and seeing how things are looking. And we'll just be having some conversations and see if we have any questions and answers towards the end of this session. But let's talk a bit about term insurance. So what do we mean by term insurance? A term insurance, as the name sounds, is more or less whenever you're getting a form of insurance that is for a specific period. So the period could be 10 years, 15 years, 25 years, 30 years. That is what a term insurance typically is, for a specific period. And usually, most of the providers, they do it in a block of 5 years. So usually that's the way it goes. And term insurance, I'll say, was one of the major foundations, or I'll say history behind the insurance itself, which is more on, trying to protect the individual, and, paying out to beneficiaries. So any form of payout to beneficiaries, that's the history behind life insurance in itself. So what do we see in term insurance? And it's very vital that we know, those kind of things, those signs, attributes, those things that we can say, okay, me seeing this, I can know this is a term insurance. Usually, term insurance is very simple and it's affordable. So usually it's not complex, just very simple, and it's usually affordable. Just to say, within this term, say maybe 10 years, you're getting yourself insured, and if anything happens, they pay out to the beneficiaries to cover final expense and every other thing, because we know in North America that everything is about taxes. So there's always that final expense, and if there's anything left, whatever the payout to beneficiary is, they can use to do the final taxes as well. So that is term insurance to start with. The other thing we'll see in term insurance is there's an item. So what the individual is paying the insured, and whatever payment is coming from the owner is just the cost of insurance. So in insurance, there's always the cost of insurance, and there could be another bucket called the cash value. In term insurance, there's nothing on the cash value. It's just the cost of insurance that is being paid for. So think of term insurance like your vehicle insurance, your auto insurance. In auto insurance, you pay those monthly premiums. However, if by any reason you miss payments and maybe there was a reminder sent and still payment was not, done, that insurance gets cancelled, terminated. So it's more or less I'll call it a pay as you go kind of a thing. That's what term insurance is as well. Just, you can always compare to your vehicle insurance. So there's no any missed payments. Maybe a reminder is sent by the provider and still it goes missed. That's all. That coverage is terminated. Think of it as well like your home rental. You're paying rent if you're renting an apartment, a property. You're paying rent, and the very month you stop paying rent, that very month, that's the end of that contract. In some cases, the landlord can find a way contractually to get the renter out of his property. So that's just the way term is. There's nothing that you say that you have a stake in that property. So your monthly payment is gone. If you paid it, and that's it, is gone. So that is, in a nutshell, what term insurance is. So I'll just keep going. Now, we have two broad kind of insurance, like the one I started off with was the term. The other one is what's called the permanent insurance. So from the name, we can see that this is, it is permanent. It's not based on, between one time, a block of time to another time, a start and end date kind of a thing. No, it's permanent. And there are two major types of permanent life insurance. And permanent means the person for life is being protected. And there are two broad permanent life insurance that we'll be talking about. The first is the whole life, and the other one that we'll be looking at is the universal life. And I'll say this is more specific in Canada, but in the US it's very similar. And they also have what's called the indexed universal life, IUL. So it's very similar to the universal life in Canada. And these concepts, though there might be slight tweaks or lingua that are slightly different, but the concept is the same across US and Canada. So in the whole life, we have it's a permanent coverage and it's stable. In the whole life, it combines protection with savings that comes with a guaranteed return on investments. So it has a guaranteed return on investments in a whole life. So a whole life, and there are several providers for whole life, and what the guarantees they are giving, they're saying, okay, for this your investments, we are guaranteeing you this percentage as return on investments annually. And some of them we have mutual companies, we have participating whole life. You are also You can earn dividends and all of that. So you have a stake in the company. There are most of the whole lives we see around are participating whole life, although some might not necessarily be participating whole life. But the whole life concept in itself is a permanent life insurance, and you have a guaranteed cash value growth on your investments. If you recall, I mentioned earlier that within insurance, we have what is called the cost of insurance, COI, and we have which pays into the cost for the insurance itself. But in a permanent life, we also have what's called a cash value, and is the investment bucket that um, you know the provider, the insurance company, can use those funds, invest them in different funds, in different vehicles, investment vehicles, and give you the policy owner returns on and those investments. So that's what we see in the whole life. So think of a permanent insurance, um, and for example, the whole life that we're talking about now, like your mortgage. You remember I mentioned earlier on that the term insurance is like the rental or your or the auto loan. But think of the whole life and the permanent insurance like your mortgage. Say, for example, you buy a property of $100,000, and you're paying your mortgage for that property. Part of what you're paying in the mortgage goes into the capital. So it goes into equity, goes into you owning the property, and another part goes into you the other part goes into the interest. So that is what the whole life is all about. That by the time you're paying the premiums, part of it you are building equity in the in that policy. So it's an asset class. It's an asset class of its own self. And just like your mortgage, there's growth that can come if you buy a property, like I said, of $100,000. After a couple of years, the property might have appreciated to, let's say, $150,000, and within that, the appreciation on that property goes as part of your own equity in the property. So same thing happens with um, the whole life policy that we see is whatever growth that is in the cash value is part of building your own equity. So one major thing I would like us to take out of the whole life is it gives you a guaranteed cash value, gives you a guaranteed cash value growth. So your investments, the insurance company, they are giving you some form of assurance, some form of guarantees around your cash value. And they're saying you cannot lose your money. Your money will keep growing, and you can always have your money back. We'll move on to, so now we've talked about term life, we've talked about whole life. Let's move on to universal life. And the universal life is also a permanent life coverage. However, one of a few major differences between the universal life and the whole life is a bit more flexible than the whole life in terms of premiums. So in universal life, you could get premium holidays, or premium breaks, and your coverage is still intact. There's also cash value investment growth. However, a major difference in the cash value is the universal life, the um, provider, the insurance companies, they put the investments in the market. So it's based on in the market. So in the stocks, on how the markets react and fluctuate. That is how the whatever your investment is. That's how it fluctuates. So the universal life also is also a wealth transfer strategy, very similar to the whole life we saw earlier. So it's also a permanent life. And some advantages that I'll say of the permanent life insurance compared to the term life insurance. One is that cash value, the growth in the cash value. Two, you have the opportunity to assess the investment personally. So a lot of people, especially within the immigrant community, and not just immigrant community, just generally, when people hear about life insurance, it's more or less, are you wishing them death? That kind of a thing. Is it, once they hear life insurance, it goes on to, death. And that's not necessarily the case. And number two is um, some people have you know, the mindset that um, the life insurance is just for, the beneficiaries, the people they leave behind. And that is not the case. For term life, yes, that could be the case. But for a permanent life insurance, that is not the case. It's an investment in itself. Like I mentioned earlier on, a permanent life insurance is an asset class. And part of what you could do with your permanent life insurance, you could make withdrawals yourself. So, in a permanent life insurance, you could get some money back yourself. And there are three major ways you can access money in a permanent life insurance. One is by direct withdrawal, so you can draw down whatever you have, in your cash value. You could do withdrawals, um, uh, and that is also subject to ACB tax-free withdrawals. If I may want to clarify, tax sheltered with withdrawals. However, that is also a function of your ACB, which is a limit to what you can withdraw without triggering any taxes with the for example in Canada with CRA. So you can do withdrawals. You could do a policy loan. So very similar to if you own a property and you have a mortgage and the property has appreciated over the course of the year or the years that you've run the mortgage, and you could go approach the bank to say, okay, I want to take out a loan, it's usually called a HELOC, from the property. The good thing about a life insurance policy that is different from other asset class, like even if you own a property, is with a life insurance policy, for example, with a mortgage that you want to access some funds from it through HELOC, you will go through an approval process. There's so much of approval process, qualifying process. You have to do this, do that, do that. Probably you have a job. They look at, your bank statements, your bank slips, and all of that. There's a whole list of approval process. But on the permanent life insurance policy, you are in total control. You can have access, tax-free savings, investment money from your permanent life insurance cash value. Total control is just write a note and you get your payment without all the hassles of qualifying, of, so many verification of, back and forth. Here, the money is in your total control. You can always have access to it. So I tell people, I advise people, why not? These are some of the benefits you can get personally in your permanent life insurance policy. So if you're thinking, oh, it's just for other people beneficiaries, no, you yourself, you can have access. So you have a project coming up, you want to go on vacation, you want to buy a new car, you want to, you even want to get a new property. You can, if you can access the money in your life insurance policy to pay for those things, to maybe as a down payment to another property, as paying for children's education. These are different vehicles that you can use. And the third way is you could also use your life insurance policy as a collateral that you could take to the bank and get what's called a collateral loan. So you can get a collateral loan with your permanent life insurance policy because it has a cash value that is an investment vehicle that has grown over the years. So you could go to the bank, say for example, you have a policy and you finish paying the premiums, maybe a 20-year payment, you finish paying the premium, you are 40, you go that policy while you're 40, and maybe the payment is for 20 years, and at 20 years you are 60, and by 65 you're looking at, okay, retirement is something that you can go to the bank and say, okay, bank, because at that point you've even finished paying all the premiums, so it's already, there's no question about, oh, will you pay the premiums or not? And you take it to the bank and say, okay, bank, I give me a collateral loan. That alone is it, and with that collateral loan, you could tell the bank, okay, pay me every year. Or you could also take it and, convert it into an annuity that you get payout every year, till death. So there's a lot of options. There are a lot of things that we could look at. Like I said, it's an asset class in itself. The same way we think of properties, stocks, mutual funds, ETFs, commodities, crypto for some people, you know, different types of investment vehicles. This is an asset class in itself. So we'll just be moving on because of our time. Yeah, and we see we have some other life insurance or insurance policies, the critical illness, which is very, very good. Everyone should have this because, life throws things at us. Says if life throws you lemon, you make it into lemonade. We don't know when things happen, but, we can be prepared and protected when things happen. So the critical illness, depending on the contract and the definition, if any kind of illness comes up that is defined as a critical illness in the contract, the person, the insured, gets paid a tax-free lump sum payout, and this could be, any illness, and can really, really be helpful as a financial relief, peace of mind, and income replacement when those things we don't plan for them, but certain things come up that well, yeah, they come up and it's out of our own control, but we can always prepare if they come up. And it's a great support when you need it most to cover expenses and income when you cannot. So while people are trying to get recovery and recover and get themselves back on their feet, your bills and expenses are not taking a break. They keep piling up or even if not you, it could be a child, a parent that you want to, give some care to. You know that your if the person has that that coverage, at least you know that there's something coming into the family. Say, for example, you get a critical illness for a child, you get a critical illness insurance for a child, your child, and the child has um, some form of sickness that you have to take time off work to care for your child, or could be a parent or a spouse, anybody, that time that you are not able to physically go to work and everything, that payout, that lump sum payout to that person can help cover those bills and expenses, because like I mentioned earlier on, the bills and expenses, as long as we live, they keep piling up. Okay, the next one is disability insurance, and which is also very, very important. Um, this is also something that can happen. Nobody plans for it, but yeah, things happen, accidents happen, things we don't plan for happen. So the disability insurance also helps to replace a portion of income when you are indisposed due to illness or injury, and it helps replace paycheck. If you are self-employed, it's something that you should actually consider. It's really high there for consideration, and grants gives you that income security while you are not able to be on your feet. So these are a few insurance that we've looked at. We've looked at the term insurance. We've looked at the permanent insurance. We've looked at the whole life and the universal life. We've looked at the other insurance like the critical illness and the disability insurance that when you're indisposed, these are lump sum tax-free payments. And it's very important. I'd like us to look at this slide, pay attention to these slides, this particular slide in rounding up, that is very important that you plan for the life realities. Things happen in life, and we are well prepared and we plan for it. And there are four major realities that we come to see in life generally. One, known expected things, occurrence, events happen to us. And on the other side, we also have known unexpected life events that happen. Then we have unknown, unexpected life events. And also we have known neglected life events. So for the known expected, for example, you have kids. I think for every parent, one of our major desires is, our children's education. So kids will definitely go to school, and you want to plan for their education. Most of us we have a desire to own our own home, or we already do own our own home. So in terms of mortgage, and part of this certain things in life is retirement. We are growing older. We can't, time is going, time is clocking and clicking out, and yeah, we grow older by the day. So the earlier, the better we plan and prepare for that life stage. And one of the major vehicles that we've looked at today that can help is life insurance, term life, universal life, whole life. They can help us prepare, plan, and protect these life realities. For example, children education, God forbid, someone passes on, a payout can cover, those life expenses, those things that will always come up. Even the children want to go to school, your cash value, that is an investment in itself, like we talked about. You can borrow out of it to pay for children education so that they don't need to take out student loans. Your children want to buy their own property, you can go into a cash value, a policy that has a cash value, a permanent life, and take out some money there and gift it to your child to use as a down payment to buy their own home. So these are vehicles that people have used and it has really benefited them. The next one is life realities, events that happen, the known unexpected things that happen around us. Yes, we know that one day everybody came into the world and one day everyone will leave the world. So, the known unexpected, when life happens, how do we protect ourselves, protect the ones we love with I'm working on vehicle, and we can see that with the life insurance term, universal whole life, we can, plan and protect and prepare for that. There are two major constants in life. We grow old and we leave this earth. Those are constant. We can't change it. There's nothing we can do about that. So it's something that calls for us taking action now. What other life events throws at us are unknown, unexpected. So these are things that we never planned for. We never crossed our minds. Things like critical illness that we talked about, disability, accidents. We can use a life insurance policy to help mitigate that risk, because these are all risks. These are all life risks that we need to have a mitigation plan, a plan in place to mitigate the risk. Yes, we are born healthy, we're looking good, things are going perfect, However, as we grow older, as time clicks in, different things start to creep out, based on environmental factors, so many things. And, you hear people, we can see the rate of, things like cancer, diabetes, and all those terminal illnesses are on the rise. A lot more people are, having to deal with that every day. And it's the who knows? Nobody knows. We are not. No one is expecting it, but it happens, and it's better to get prepared. Accidents happen, workplace accidents, home accidents that can make us indisposed to go to our businesses, our work, to earn a living. And to mitigate all of that, it's better to have a plan in place. It's not when that thing happens, and that's the question we need to always answer to ourselves. It's not when something is showing up, at the point that it is showing up, that you're thinking of getting a life insurance. A life insurance is what you get when everything is good. Because when things start to show up, when things start to happen, guess what? The life insurance company, what will they say? Oh, sorry, we cannot cover you. You are not eligible. We cannot proceed with the policy, because at that stage, something has come up. So when is the best time to get a coverage, a policy, or take action? Is now. It is today, before something else creeps up, something else comes up. So this is the best time. And we have those known neglected deaths, um, estate taxes, final expenses, wills, trust, personal power of attorney, personal health care directives. These are things that we need to put in place. We have a topic like you saw at the beginning. We have a topic that will dive more into estate planning and all of that, and we'll be talking more on that, in the coming weeks. But what are the mitigation strategies that we can look at is having a life insurance policy and preparing all our estate documents in the proper order, having all of that laid out. Because one of the things that people need to realize is in North America, there's already a default will, there's already a default um, healthcare directive. All these documents, there's already a default one given to everyone, already done for everyone by the government. So it's not about is there one in place or not? No. There is already a default in place by the government in Canada, in the US, and the only way you can demonstrate that no, the will that the government has put in place is not favorable to me and my family is when you put your own in place. That's the only way you can have something standing. So without that, things will just go by default. And by default, I mean, if you have assets, properties, and everything, the government will first take out their own taxes and take out everything they need to take out. The creditors will also come after all of those assets, and it's whatever is left when taxes have been paid, fees have been paid, goes through probate, goes through lawyers, goes through all of those things. Creditors are coming after whatever is left. Is whatever is left that goes to the family. But that is not what we should be thinking. We should be more on the side of getting things right in place and creating that generational wealth that even before you pass, you can put those things in place. Yeah, there's what's called the living trust, that even while you're alive, you can have a trust, set things in proper place, and you are the one in control, giving directive on how you want, what you worked for all your life, how you want it to be distributed, or how you want it to be run. And it's giving you a voice even when you're not there. And that's how you should be, not going by the defaults that the government gives, and everything more or less goes back to other people neglecting, forgetting the people that you love and care about. Because tell me, if you truly love and care about them, you need to set all of this that we've talked about in place. Your life insurance policy. If you truly say, I love my family, I care about my family, I value my family, and I value myself, you need to have all of this in place. For example, it's only a critical illness or disability insurance, critical illness insurance or disability insurance. If you value yourself as an individual and it is the work I do that I can get income to take care of my bills and expenses, you need to get that. Because what happens when something comes in place and you don't have, you cannot go to work or do your business to, get all of those things in place. Those bills and expenses, they are not waiting. They keep coming bi-weekly or every month or however the case may be. And they are not saying, oh, let's take a break for you. No, they will keep coming. So you need vehicles in place that can help mitigate any of those risks. And that's what we're talking about. If you truly value yourself, if your life is valuable to you, you need to get a life insurance for yourself. If your family is valuable to you, you need to get a life insurance for yourself, to help, protect. Because what happens, some people say, oh, the premiums in this insurance is too much, the premium is this, the premium is that. But the question I ask is, even on your vehicle insurance, you want to own a vehicle, you need the vehicle to go to work, to do all that you need to do. So just to make your everyday life going, you pay a premium on the insurance to get on the vehicle so that you can be mobile, get to work, go and earn a living and do one thing or the other. So you can do that. How much more your own life and how the impact it will be, to your family if you are not there. So the way the mindset is, it looks as if you're paying those premiums, but what you're doing is just a little bit of the iceberg. And like I said, even you yourself can benefit while you're alive. There's what's called living benefits. We've talked about how you can, withdraw from your policies, the several types of withdrawals that we talked about. You yourself, you can benefit from it directly. And how much more, the ones you love, you can leave something behind to create wealth for them. So it's the premiums you're paying is like, you're working for the policy now, but it comes to a point in time, is the policy that will be working for you. It will be like passive income when you're not there to do the work yourself, when you're incapacitated, you are indisposed, that you cannot, do the work. That policy is now triggered to provide for you and your family when you are not able to do it. So that's the one major key point that key takeaways or key point that I want us to take tonight. So we've come to the end of today's conversation. Like I said, it's a continuous conversation. We'll be having this conversation, just a time to meet up, say a few words to one another, say it as it is, so to speak, that this is what's happening. You need to plan out things, and we'll still come into the topics on taxes on, tax sheltered vehicles, creditor sheltered vehicles, because the way it is if you're putting all your eggs into one pot and say, oh, I'm doing this investment or that investment, are you putting anything in place to protect your investment? If anything happens and there's a crash, do you have a backup? Do you have something in place to protect it? And in the event that something, people pass on, do you know what tax bracket that person will be? Something just came out in the news last week. A couple that, in their RRSP, they have about $715,000. And from that RRSP that the couple had, they passed on, and the children had to pay $660,000. So you can just imagine the children have to pay $660,000 to the CRA in taxes, and it's in the news. So you can just imagine what were the parents working for all along. And like I said, if you don't take control, there's already a default that is in place by the government. If you think you're negligent, or okay, I don't care, I don't know, I'm not bothered about what happens, there's already a default in place until the point you take charge, you take action, you come to a realization, you take action by yourself for your own benefits and for your family's benefits. I believe that couple, they won't have ever thought that their children will be left to pay $660,000 in taxes out of 715 because the government is seeing it as capital gain, and that's what they're taxing the children on in their RRSP. And the point that the family was, the couple was at, the tax bracket they were. So putting all of those in place, I believe the parents would have preferred that money going tax-free, tax-sheltered, creditor-sheltered to their children. And see how far it would have gone if the children had that entire $715,000, what it would have done for them. So this is a wake-up call, just to give some time, if there's anyone with any questions, I'll be happy to talk about it. But like I said, you can always reach out to me. And okay, I see a question coming up. What could the parents have done to shield the funds passed down? So yeah, a very valid question. And one major thing that I think the parents would have done differently is to look for tax sheltered, creditor sheltered vehicles. Instead of having so much money in their RRSP. Now remember, an RRSP is government has full control over it. They have full purview. They see everything in it, So you cannot say otherwise. But in a life insurance policy, that payout would have gone directly to the children, tax shelter. They're not paying out any taxes. So if that fund was in, say, for example, a life insurance policy, and if you heard commentators and advisors even on that news, that was part of what they mentioned. It's very, very phenomenal. Having a life policy that nobody can come after it. Creditors cannot come after it. CRA cannot come after it because it is a life insurance policy and it's paid out to the beneficiaries. And if there's anything that is left for the couple in terms of final expenses, is the children that will now decide on how they want to go about it, on how to distribute or dispose assets or settle things out. But now they don't even have an option. They are not even being there's no consideration to them. This is what is being owed, you need to pay it up. So if in retrospect, part of what would have been advised to the parents is, and we see a lot of people doing this and making this mistake is they are trying to put so much into their RRSP. If you're a business, so there are several strategies. If you're an employee, you might not have the option of saying, okay, I'm not putting something in RRSP because your employer is already doing that for you. So if it's the employer side of things, that's fine. But from your own personal deductions, depending on the situation, my advice is there are better tax sheltered strategies to use. And one of those tax shelter strategies is getting a life insurance policy. For business owners, on the other hand, I'll advise business owners, make sure you are exhausting all other options. For example, your life insurance, your TFSA, other tax sheltered vehicles, make sure you are exhausting all of that before you think of doing an RRSP. Because an RRSP, the older you get, you are getting into a new tax bracket. The older you get, the more income your new income bracket, the higher income bracket that you're getting into, the higher your taxes, on the RRSP at payout. So for business owners especially, that you can manage things, I'll say make sure you're exhausting your life insurance, your TFSA, before thinking of RRSP. So that would be my own advice. So thank you for that question. I hope I answered it. And if there are any other questions, yeah, I'll be happy to help. Critical illness and disability insurance, can this be assessed by contributors at, just trying to see the question, can this be assessed by contributors at old age for home care services if they are able to care for themselves? Well, so it depends on um, uh, the the coverage, it depends on the term, um, and so there are so many factors. Are they do they still qualify for it? So, for example, let me say a critical illness is coverage for maybe 20 years. Do they fall within that term? If the person falls within the term of that coverage, yes, why not? The payouts will be given. The same thing, disability insurance. So, but um, for example, a disability insurance will be more tailored towards um, people that are active. People that are are in the active service, they can do something. So in old age, there might be certain clauses, there might be certain criteria for old age that before they can get those kind of coverages, because for example, the disability is more targeted to people that are active, that are earning income, and that income was one something to replace that income for them. So are they still working? Are they still doing something to earn income? So all of those comes to play. So if they meet all the criteria, definitely yes, it's something that can be explored. So it's very important that we understand that it's not just open and they all have the requirements, criteria that we're looking at. So thank you again for that question. And some of these things are also case by case basis. So a whole lot of things also change with time, but generally speaking, depending on the provider, depending on so many factors, there are also government factors that come to play, especially for disability insurance, that we will need to look at. What do you have to say by long-term care insurance? Long-term care insurance, yeah, is good, but I'll say it's more on the health care insurance, so to speak. So it's more on the healthcare side the uh, for seniors and all of that. And yeah, it's something that I will advise, as people are getting into those golden years, that they can take out, they can get an insurance at least to cover, all care at that age. So it's a very good insurance out there, especially for retirement, towards retirement. Very good because, it comes to play when, in old age, in those golden years, senior years that, people will need care, health care, and so many things to go. And usually the strategy that I see people doing is by time, um, for example, we talked about things like annuities. You have your whole life insurance, your permanent life insurance. You can get a collateral loan into annuities, so many annuities that you are having a regular payout. You can buy a long-term care insurance that you are covered by that insurance, for your care. So there are so many strategies, and this will really help people, in those in those senior years. So yeah, you're welcome. Yeah, you're welcome. Thanks for the questions. Like I said, we'll continue the conversation next week. And for next week, we'll be seeing in the power of cash value. We'll be looking at the power of cash value, practical strategy for savings, investments, emergency funds, and we'll be talking about the law of compounding. It's a law, just like the law of gravity. We'll be looking at the law of compounding. So thank you, everyone. My name is Remy Obadele again. You can reach me on 306-450-4563. Also, I have social handles that I'll be sharing, but thank you. Really appreciate the time, and yeah, have a pleasant evening. Thank you, and bye for now.
Thank you.